Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And over the past week or so, markets continue to grind higher back to new all-time highs. You have the Dow Jones printing a 40,000 print, S&P at new all-time highs, NASDAQ at new all-time highs. And the question is whether we continue these all-time highs to further new all-time highs. So let's take a look at the charts and try to answer that question. What we saw here last week, like I said, is the S&P 500 breaking out above that 5250 all-time high, printing that 5300 all-time high. The one thing I do want to point out here is you can see higher highs in price no longer being confirmed by higher highs in momentum, showing some signs of exhaustion here from buyers typically seen near market tops. Not necessarily saying that that is going to be a market top, but there's certainly one level of caution about these new all-time highs of potential reversal from here. On the flip side, the NASDAQ 100 also made a new all-time high. But the thing is that the NASDAQ 100 did confirm those new highs. So it's not like we're seeing this across the board, but at least between the S&P 500 and the NASDAQ, we're seeing some level of exhaustion here on the S&P 500. And we'll talk a little bit about kind of the strength we've seen out of technology and what that means regarding our views for equity. So a bit of a mixed picture here across the major indices. The Russell 2000 did not reach back to its recent highs. As you can see, still a bit of a ways away from reaching that new all-time high. We would generally like to see the Russell 2000 break to new all-time highs in order to confirm the new highs that we've seen here on the S&P 500. Until that happens, I'm myself in a bit of a more cautious tone here. Not necessarily just expecting that new all-time highs will bring further upside. When you see the fact that there's some level of exhaustion and that the major indices, not all of them have made new all-time highs, still leaves me I'd like to see that before we would call a more bullish tone here to the broader markets, especially when you see that the equal weight S&P 500 also has not made it back to those new all-time highs. So the equal weight basically showing us the rally over the past few weeks have not seen as much participation across the board as the market cap indices might suggest. So the majority of stocks having not participated in terms of the new all-time highs is a further concern about the strength of the current rally that we've seen now that the Dow and the S&P 500 broke to new all-time highs. Looking at what has been performing over the past year or so, growth continues to outperform value. But over the past few months, we've really started to see value outperform growth. But that has started to reverse a little bit here, I'd say, over the past 3 weeks, kind of continuing that growth outperforming value. And we talked about this chart here over the past few weeks that we really would like to see growth come back in terms of leadership in order for us to have more confidence in the rally. And we have seen some forms of that here over the past few weeks. And we'll also talk about some of the specific sectors that we're seeing the strength that help us understand the context of all of this. Commodities recently broke out from this kind of downtrend that we started to see after what has been a big move here to the upside in terms of commodities. We've consolidated for a little bit. Now we're starting to break out a little bit to the upside. Can anyone still hear me? Yep. Okay. So this really puts commodities back into a bullish trend here right now, especially on the back of gold. The strength that we've seen here in gold is really what's been driving this movement here. Yesterday, in terms of intraday, we saw a new all-time highs in terms of gold futures. So that's been really rallying the commodities markets as a result of that. When we look at high yield corporate bonds and we look at the riskier end of the curve with regards to bonds, we see that after what was a big move, after what was a big move here to the upside in terms of riskier bonds, it's been trading largely sideways for the better part of of the year. And what we started to see here over the past few weeks was a little bit of a rally here from the riskier end of the curve with regards to bonds. And this is generally considered a risk-on signal that we're seeing from the bond markets. We did print a new all-time high, or at least a new relative high recently. It hasn't really seen a lot of follow through to that momentum, but it has managed to hold on to those highs so far. So overall, bond markets giving us a more risk-on tone here for equities. Now, the VIX, we did see the VIX close at a one-year low. As you can see over the past year or so, we have not seen it close below 12. I believe on Friday we closed at 11.99. We're at 12, just shy of, just a little bit over 12% in terms of expected volatility in the next 30 days. This, in my opinion, provides an opportunity to be long volatility as kind of complacency has sort of set into the overall markets. Expectations for vol is extremely muted over the next 30 days. So I certainly think that this brings some opportunity for those of you that have a directional view in the markets, whether that's bullish or bearish, to take some convexity by being long options because they are so incredibly inexpensive at the moment. So if you do have a directional view, this is an opportunity to take those directional views by being long options as option prices are very muted. 10-year treasury yields just continue to moderate around that 4.4% range. We had the CPI print last week, right around the 4.4 mark, right before the print. We saw a lot of volatility right after that print, but we're right back at that 4.4 level. That really speaks to the fact that, bonds haven't really changed in terms of their calculus for rate cut expectations going into the second half of this year. Right now, we're still pricing in 2 rate cuts. Expectation is that the CPI print last week doesn't really change things by much. What it does do is it keeps the door open for 2 rate cuts this year. And that's kind of what equity traders are hanging on to right now, are at least 2 rate cuts this year. If there's any risk that turns into 1 rate cut for the year, that would certainly be a bit more bearish for equities. At the moment, I don't think we have enough data to suggest that there will be more than 2 rate cuts just yet. But certainly if we do see more than 2 rate cuts, that would be a very bullish signal for equities. TLT, long-term bonds. We continue to respect this downtrend line. So a couple of days ago, traded up against that trend line, bounced lower here. So my hunch is still that bonds will continue to trade lower from here going forward, which would convert to a higher yield, which is going to be a bit of a headwind for equities. Now, we saw the dollar index break below that 105 support level here. This puts it back into the trading range. It also broke below that 50-day moving average, having the propensity now for dollar to potentially drop a little bit lower from here. This is the gold chart that I was talking to you before. We did print a new all-time high intraday. So far, we have not seen a close above that 24.50 level here. A breakout here above 24.50 would be a continuation of this bullish trend and quite bullish here for gold. My hunch is that this could have the momentum to break out higher here and continue in the next few trading sessions. So gold, at the moment, still looking quite bullish here right now. Oil still sits below this $80 level here right now, but we did kind of call this double bottom here from last week. This double bottom around 76.5, 77 or so gives the oil the potential to break out here above 80 and kind of head back into the high 80 range. We haven't gotten the breakout here just yet, but certainly the setup is primed potentially for a breakout here for oil, which also would be so supportive here for energy stocks. And then looking at the sectors, this is really the one that I think is worth paying attention. Technology, as you can see yesterday, not only printing a new relative high, printed a new all-time high yesterday. So the strength that we've seen out of technology is something that we want to see as equities breaks out to new all-time highs. You need leading sectors to lead in order for us to have confidence in the market rally, and we are seeing that from technology stocks. They are giving us that bullish signal and they are outperforming, which is a good thing for those of you that are in the bullish camp here for equities. However, the one thing I do want to point out here is that consumer discretionary is not joining technology on that leadership. It's doing the exact opposite. As you can see, consumer discretionary over the past few weeks have gone absolutely nowhere, but that actually means that the relative performance to the S&P 500 is incredibly poor. The consumer discretionary sector has lost about 5 percentage points of relative performance to the S&P 500 in just the last 3 weeks. That's an incredible amount of underperformance. And if you think about the fact that the US economy is driven by consumers and the fact that consumer discretionary stocks are looking so poor from an outlook perspective, it really, in my opinion, offsets a lot of the strength we've seen here in terms of technology for the strength for equities. So the two, to some degree, almost offset each other at the moment, not giving me that full confidence in calling that these new all-time highs will likely bring fresh new highs for equities unless we start to see consumer discretionary participate on this rally. And the moment it's doing the exact opposite. Communications failing to break out to new all-time highs, even though the fact that this was one of the leading sectors, which is also another concern for me at the moment. We see financials outperform, made a new all-time high, but it has the same issues with the S&P 500, higher highs in price, lower highs in terms of momentum. The relative performance over the past few weeks has also been not particularly spectacular. So financials, JP Morgan did lift full year guidance for revenue this year. However, that, in my opinion, is not quite enough to change kind of the landscape of the entire sector right now. And notice JP Morgan yesterday, despite after lifting expectations, was down, 4.5% yesterday. So I think financials in a spot of trouble here right now. Consumer staples, on the other hand, showing some strength here, kind of that defensive sector, which if you think about which sectors should be performing in a strong equity market where you're confident in a bullish market, it should not be the defensive sectors like consumer staples, should be consumer discretionary. So that's another thing that, I think from my perspective is concerning for the current market. Healthcare continues to underperform, materials underperforming, industrials underperforming. So as you can see, basically no longer making a new high in terms of industrials, converts to an underperformance here relative to the S&P 500. Real estate underperforming, failing to kind of break anywhere near back to new recent highs. Energy showing a little bit of strength here, not quite enough to reverse the downtrend here, but perhaps if oil starts to see that breakout above 80, this is really where you do get some of that outperformance. And then utilities. This has been the strongest sector here of all the sectors, which is a very, very defensive sector right now, which is why if you look at what's performing and what's not, the only thing that you like to see that's performing, that is actually performing, is technology versus all the other sectors that are performing at the moment are the ones that necessarily are not the ones that you want to see, like energy and consumer staples and utilities. These more defensive sectors are the ones that are outperforming right now. Not what you see when markets print new all-time highs. So home builders is kind of hanging in there right now, but not really a lot of action at the moment. Still not near those all-time, not breaking out to new all-time highs yet. And the one I think everyone has eyes on this week is semiconductors. NVIDIA reports earnings on Wednesday after the close. And as you can see recently, semiconductors showing a little bit more strength here, breaking out above that 230 level on the stocks index. As you can see, the relative performance here over the past few weeks have been quite strong. We've seen a nearly 10% outperformance from the semiconductor industry relative to the S&P 500 over the past month or so. So this is really where you do see some of that outperformance here right now. So with that, taking a look at some of the charts that I think are worth paying attention to here right now. One of the big ones is really JP Morgan. We spoke about this a little bit. Basically making new all-time high. Note that we didn't break out to new all-time highs in terms of the momentum. And, JP Morgan trades at nearly 2 times price to book. So from a valuation perspective, trades at a very higher end of the curve in terms of historical valuations, yet we're expecting revenues to grow by, just a couple of percentage points. So the fact that it's trading at the higher end of its historical valuation, while growth expectations are virtually non-existent, and you see the exhaustion that we've seen here in terms of higher highs in price no longer being confirmed. This leads me to believe that there's some further downside here for JP Morgan. One of the stocks that we're taking a look at here right now is Hilton. Hilton, as you can see, failing to kind of reach back up to those recent highs. And as you can see, momentum is actually quite poor. Momentum is quite poor. And what you get is basically a higher high, lower highs in terms of ever since we made those recent highs. And the relative performance since then has been quite poor. Momentum here continues to turn negative. So the suggestion is that perhaps we start to see some further downside here from stocks like Hilton, some of the discretionary stocks, some of the travel stocks not really performing. See the same thing here from Fiserv. Basically similar chart setup here. You basically have a high that we recently printed a couple of months ago. Since then, we failed to make new highs. We continue to make lower highs. And really, this is despite the fact that it's still trading sideways. But what you see here is that the relative performance is incredibly poor, starting to break to new relative lows. And that suggests that there's some further downside here. And it's likely potentially break below this, let's say 145 support level and continue moving lower here. So Fiserv trading, about 28 times forward earnings, certainly on the expensive side of things, and momentum has recently turned negative. So a potential bearish opportunity here in the broader markets. And then one last one I'll take a look at is Kroger, the supermarket stock. Kroger, as you can see, had a really nice run here from 44 up to that $58 run in just the past few months. But after kind of breaking to those new highs, it's starting to look a lot weaker and starting to roll over here. If you look at that relative performance from Kroger, extremely poor. I think there's some further downside here for Kroger. I think it's likely going to break that $54 level and tumble pretty quickly, close to that $50 mark, which would close that gap. And then if it gets even lower, we're looking at the high 40s as our further downside target here for Kroger. So those are some opportunities to pay attention to here right now. Most of them here to the downside, given the current market macro perspective that we're seeing. New all-time highs sounds very bullish, sounds very positive, but if you look at the market internals, in my opinion, we're just not there, just not yet. We'd like to see some of the other sectors reverse back into strength. We'd like to see some defensive sectors pull back in terms of strength. And perhaps in that particular environment, we might get to a point where we're a little bit more confident in this market rally, but we're just not quite there yet. With that, thank you so much. I hope you guys have a great trading day. And I'll see you guys here next week on our next Market Outlook session.